Mean reversion. Stock is going up, bad news hits, it has a dive, people overreact, and then it bounces back up. You buy the dip, sell the rally is mean reversion. Rotational momentum, buying the strongest stocks, and then when they fall, then you buy the strongest stocks, and when they fall, you buy the strongest stocks, and you keep rotating into the strongest stocks. These are different strategies that you can diversify into as well. So it's not just about markets, it's also about trading different strategies.
Okay. Hello, ladies and gentlemen, and welcome to our interview with Adrian Reid. Adrian is a full-time stock trader over 20 years and the founder of Enlightened Stock Trading. Trading full-time since 2012, and he has experienced every trading mistake you can imagine. And now he is running his own community, Enlightened Stock Traders, and he helps them to avoid these mistakes. So, Adrian, welcome to our Risk Management Show podcast today.
Thank you so much for having me. Trading is all about risk management, so I'm actually very excited to speak to you, even though it's a little different to maybe what you normally speak about on the show. I think there's a lot of commonality between risk management in other areas, risk management in trading. And like you said to me offline, I think a lot of risk managers also like to trade. So we can probably have some useful discussion here.
Absolutely. So, yeah, I believe that we will have a very thoughtful conversation on the topic of the role of systematic trading in managing market risk, diversifying strategies to withstand the volatility, and how technology aids in avoiding human errors in trading. But before that, Adrian, could you tell us a short story about yourself, your career path, and what brought you to where you are right now?
Sure, absolutely. So I trained as a chemical engineer way back. And when I graduated, I started working in strategy consulting. And it took me not very long before I realized that I didn't want to do that for the rest of my life. I mean, I loved strategy consulting. It was fascinating, interesting, good challenges, but it was very, very hard work, terrible on the lifestyle. And I really wanted to live a life of freedom. And so after must have been several months working, I said to my father, how can I retire? And he laughed at me. He said, you only just started. What do you mean retire? And so I said, no, seriously, like, how do I retire early? So I don't have to work in a corporate job for my, until I'm 70 and all that. He said, well, basically you need to learn to invest so your money can work for you. And that started me looking at investing. And I looked at investing in business, investing in property, investing in shares, in stocks. And, I didn't have a lot of capital back then. I was just starting out. So property was out, buying a business was out, and I didn't know anything about starting a business. So I looked to the share market. And from there, I just basically started doing what everyone does at the beginning, buying good stocks that companies that I recognize, companies that I thought had good products, taking advice from people who I thought knew something, taking advice from stockbrokers who I thought would know something. And of course, none of these things worked. And I tried many, many different approaches to the markets over my first 3 years trading. And all the while, my account was just going sort of sideways and down, sideways and down, sideways and down. But I never lost everything. And I think I know the reason that I never lost everything at the beginning, even though I didn't have a strategy that worked, the reason I never lost everything is because I was a good risk manager from the very beginning. Because I'm inherently fairly risk averse, and I'm also focused on what could go wrong. And that obsession about what could go wrong led me to mitigate a lot of the risks and avoid many of the things that most traders do wrong. So I survived that learning period. And then eventually I discovered systematic trading. And systematic trading for me was the answer, really, because all of a sudden I had rules. We'll get into what all this means. But all of a sudden I had rules and approach that worked, and my account went from kind of dribbling down to all of a sudden making money and growing. And basically then it was a matter of, once I had a strategy that worked, compounding and adding capital and diversifying and building my portfolio of strategies to the point where eventually I could step out of the corporate world and trade for a living, which I did in September of 2012. And I've been doing that ever since. So that's where I am now. Most people say, great, trading for a living, that's the dream, right? But I left my corporate job in 2012. As I said, 6 months later, I was bored, lonely, and depressed. had no one to talk to. I didn't know any other traders. So what did I do? Did exactly what you did. I built a community of people around me who are interested in the same sort of thing. You've got a fantastic risk management community. I set about building a trading community, which is what Enlightened Stock Trading has become today.
All right, fantastic. So, as a fellow community creator to the fellow community creator, it's nice to talk to you and understand how you first doing your main business thing, and then maybe how do you manage your community. So, about the systematic trading and market risk, can you explain how systematic trading helps in identifying and managing market risk compared to traditional discretionary trading methods? And what does it mean? So you do have to some kind of stop losses or other tactical issues, or is there some kind of strategy? Can you share with us?
Yeah, absolutely. Let me first start by just for the listeners who don't know what systematic trading is, I'll define that, and then I'll talk about risk management in the context of systematic trading. So systematic trading is essentially rules-based trading. You have 100% objective rules that tell you exactly when to get in and exactly when to get out. If A and B and C are true, you buy. If D or E is true, you sell. So they're logical rules that if I have the rules and you have the rules, we get the same trades. That makes sense? So there's no subjectivity. There's no interpretation. There's just the rule says buy. The rule says sell. Now, this is really important because one of the biggest mistakes and risk management issues that traders face is not knowing how good or bad things could be. Now, a lot of discretionary traders, they make decisions by looking at some indicators and reading some articles and getting some advice and some tips, and they bring it all together and they try and make a decision based on all of the different inputs. Now, if we've got lots of different inputs and it's all going through our internal psychology, then the outputs become inconsistent. And this is a real problem. Because depending on how we're feeling, we interpret information differently and we make different decisions. Now, can you imagine a production facility like a factory? Imagine Toyota cranking out Toyota Corollas, Camrys, Hilux, and every day they make them slightly differently depending on how everyone is feeling. It would introduce huge risk, huge inefficiency, blockages, mistakes, losses into the system. They don't do it that way. They make the same car the same way every day, every time, following a process, right? And then they look at that process and they say, okay, where are all of the risks in that process? Machine breakage, person failure, stock levels, etc. And they manage those risks. In systematic trading, it's similar. We have a system, which is like the factory that produces trade signals. The system scans the market, finds the stocks to buy, tells you to buy them, tells you how much to buy. You place that trade. And then it tells you when to get out. You place that trade. The great thing about that is it makes your decisions consistent. And it allows you to test the rules to see if they're actually profitable and to see what could go wrong. And this is where systematic trading has a huge edge in risk management over discretionary trading. Because when you have rules, you can run tests with historical market data. So we have 30, 50 years of data, depending on which exchange we're talking about. We can backtest our rules over all of that data and find everything that happened, all the trades, how good they were, how bad they were, how many hit their stop loss, how many times a stock went to zero, how many times a stock gapped down, all of those things. And we can build that into our analysis and say, based on all of the history, how much should I risk on each trade? How much should I allocate to this system? When should I turn this system off? You can start answering questions that you cannot answer if you're trading with a discretionary approach.
So it's kind of based on technical analysis or other, and on kind of agnostic on the market. Every market is available.
Yeah,
Okay.
well, the rules are typically for most systems, they're based on technical analysis. You can use fundamental data if you have the time series, because part of the first challenge is having rules. So you know exactly when to buy and exactly when to sell. The second challenge is being able to test those rules over history to make sure that you know what good things, what bad things could happen, how big the dips could be, how many losses you could have, how big the losses are, all the risks you have to manage. We need to be able to test them. So we design our systems with rules that use data that we have time series data for. So if we have open, high, low, close, and volume for every stock for every day since the stock was listed. We have that data. You can get interest rate data every single day. You can get stock market index data every single day. You can get volatility. You can get some fundamental information. So anything that you have in time series, you could incorporate into your system if it gives you an edge and test it and see if it helps. And all, what we're trying to do is build confidence that the system will keep working, build confidence that we understand what the risks are so that we can position size correctly and allocate capital correctly. And all of these things we can do because we can test it analytically on historical data.
So let's discuss about the diversification strategies. What are some effective diversification strategies that systematic traders use to mitigate volatility in unpredictable markets? So is it some participating in more exchanges or just in different industry? What are they?
Yeah, it can be many things. First think about the mistakes that people typically make with their investing. I've got 10 stocks in my portfolio. I'm diversified. Like, really? You've got 10 stocks, right? Or maybe you've got 20 stocks and you feel like you're very diversified. But all of those stocks, for most people who are, just general mum and dad investors, are passive buy and hold investments. And if the market crashes or goes down significantly over 1, 2, 3 years, all of those stocks are probably going to go down. They're highly correlated. And typically, most people will invest in their own market, their home market, because that's what they're comfortable with. I started trading Australian stocks. I'm Australian. Most US investors would start trading US stocks. And the same for all around the world. But being long only, as in buying stocks, hoping they'll go up over time in your home market, is very narrow from a risk management perspective. Because if something happens to your economy, what happens to the stock market? It goes down, falls. And if you don't have diversification into other markets, then you're solely at the mercy of your home market. So one of the easiest ways to diversify, well, not one of the easiest, but one of the best ways to diversify is to go internationally, different markets. As soon as I started trading Australia, US, Hong Kong, Canada, they're the stock exchanges I trade in my account right now. When I diversified to that level, my results improved dramatically. Much smoother returns, much less drawdown, lower risk, and less risk of shocks. A good example is I was trading before COVID. I was trading Australia, US, and Hong Kong stocks. And Hong Kong is close to China, and the COVID kind of crisis was more evident in that market than it was in the US and Australian markets very early on. And so the market was falling. So I ended up going short in Hong Kong to make money on the way down, while the Western markets were still kind of going up. So I was short Hong Kong, I was long Australia and long US. So then when the COVID crisis really expanded globally and the US and Australian markets fell and Hong Kong fell further, I was already short in Hong Kong. So I was making money on the way down. It really cushioned the fall. That diversification is really, really powerful. But market diversification is one leg, one method. There's also strategy and time frame diversification. When I think about diversification, it's strategy, market, time frame. Strategy means things like trend following, buying stocks that are going up, holding them until they stop going up and start going down, and selling them. You make money out of the middle of a big trend. Mean reversion. Stock is going up, bad news hits, it has a dive, people overreact, and then it bounces back up. You buy the dip, sell the rally is mean reversion. rotational momentum, buying the strongest stocks. And then when they fall, then you buy the stronger stocks. And when they fall, you buy the stronger stocks and you keep rotating into the strongest stocks. These are different strategies that you can diversify into as well. So it's not just about markets, it's also about trading different
Strategy.
strategies.
Okay.
Yeah. And then it's also about trading different directions. Long side, short side. Make money when the market goes up, make money when the market goes down. Most investors can only make money when the market goes up. But if you can short sell stocks, you can also make money when the market goes down. That means the risk from your long side investments, when you're buying stocks hoping they go up, but if we have a bear market, those stocks start going down, you lose money on those stocks. But if you're short selling, you're making money as the market falls, it offsets that risk, and you end up with smoother results, smoother return profile in your account. So markets is good diversification. Strategies is good diversification. Direction is also good diversification. Finally, time frame. Daily charts, weekly charts, monthly charts. You can trade different time frames because there's different moves that happen in different time frames. And I like to try and get a mix of all of these things into the portfolio to reduce the impact of any one risk in any of those different strategies.
Yeah, fantastic. I also noticed that now the trend is that people buy more ETFs because they don't want to go to the analysis of all individual stocks. And now you can also buy some inverse ETF that also play, you earn money when the stock's down. So you can also play on these different strategies, right?
Yes, absolutely. You can, for some people, there's many accounts you can't actually short sell. So like, for example, many retirement accounts won't allow you to sell stock short because you have to borrow the stock, sell it. You've got unlimited risk theoretically when you're short the stock, and then you have to buy it back and return it to the original owner when you're short selling. And many retirement accounts won't allow that, but they will allow buying an inverse ETF. But there's a really interesting risk management issue here because the inverse ETF is not the same as shorting the ETF. Yes, the inverse ETF will rise when the market falls, but the inverse ETFs have time decay built into them. There's like a tracking risk. And if you hold them for too long, you end up kind of value eroding in your account, particularly if it's a leveraged ETF. And so the risk here is, do you fully understand the instrument you're trading? You know, people say, oh, it's an inverse ETF. I should buy that because then I'll make money when the market goes down. It'll hedge my losses. That's good risk management, right? Well, no. You've got to be very careful because you don't want to buy it and hold it. Because if you buy and hold an inverse ETF, especially a leveraged one, in the long term, you're going to lose a ton of money. You only want to buy it and sell it in a very short space of time when the market is falling, because that's when it's going to make money. Apart from that, over time, they just erode. If you look at a long-term chart of many inverse ETFs, especially leveraged ones, they look like this, going down to zero. And they have to keep having reverse stock splits just to keep the stock price up so they can trade. So we have to understand the instruments we're trading, the risks, and the risks inherent in that so that we can manage them appropriately.
Yeah, good, good. So let's discuss the role of technology in automation, because you have a kind of system. And how has technology evolved in systematic trading to minimize human errors and enhance the decision-making process? Because I know as a kind of individual trader, for me it's more kind of difficult to understand what stock to trade and how to trade it. And for me, it's better just to buy it and forget it until it's all in 20 years. It will be probably more valued than now.
Yeah, technology play for active trading it's a really important, well, for several reasons. Risk management is one, maintaining an edge and testing your edge is another. But I think what I've observed when people trade and make decisions manually, particularly discretionary trading executed manually, there's so much scope for mistakes. You know, fat finger errors, calculate position size wrong, making an error of judgment. All of these risks are very, very costly. And not just in the moment. If you make a trading mistake and you lose some money now, it costs you now. But if you keep making that trading mistake, the compounded impact of that over time, over 10, 15, 20 years of your investing life, the compound impact of mistakes is huge. So as a trader, one of our primary goals should be to minimize the mistakes that we make. And a good way to do that is to systemize and use technology as much as possible to automate our process. So let me give you an example. In order to make my trading decisions, I have systems, which are rules that tell me exactly when to buy and exactly when to sell. I use trading software to scan the entire market to find the stocks that are buys and sells today. So I'm not looking manually to find the ones that I think I should buy and sell. The computer just scans, uses the rules, looks at every stock on the market, finds all of the buys, prioritizes them, and gives me a list. So the computer does all of that work, and it does it in an instant, like a couple of seconds, 20, 30 seconds. And so all of a sudden, all of the decision-making mistakes are gone, which is great because that's a big chunk of the errors that people make. Then it's up to us to say, oh, okay, I have to place these trades. So I go and place these trades. Most people are doing it manually. The trouble is when you place a trade manually, you're in the middle of the process. It's like you're making a decision. Oh, okay, I've got to buy ABC stock. I'll buy ABC stock. I've got to buy 10 shares. Oh, hang on a minute. I really like the look of ABC stock. I think I'll buy 15 shares instead of 10. Or, oh no, I really don't like XYZ stock. I'm not going to take that. So I'll skip that signal. I'll take the next one. I'll just buy more in the next one because I don't like that stock. I lost money last time I made that stock. So these sorts of things happen when the trader is in the middle of the execution process. So the best way to eliminate that is to automate the execution as well. So in my trading, I have a data provider that automatically updates my data. I have my trading software that automatically runs the tests each day to tell me the buys and sells. And then I have an automation that talks to my broker and says, which stocks do I have? Which stocks need to be bought? Which stocks need to be sold? It places those trades and it sends me a report. So now, instead of being a trader, I'm a risk manager and a process monitor. So the process runs and I watch the process and check that it all works. And I decide on my risk management parameters, how much risk per trade, how much risk per system, how many systems, which markets, and then I put those parameters into the system and let it run. And then I monitor it to make sure that it's doing its job. All of a sudden, the mistakes are gone and trading can be consistent, much more consistent over time.
So you actually describe what the trading desks in the banks do, right? So you're only one person or a few persons you do work for the trading desk. They also have the systems, the software, technical analysis, and data providers. So you actually doing this for as a bank, right?
Yeah, well, I mean, this is for my money, for me. So not as a job. I know, I mean, the banks do that. The hedge funds do that. It's particularly a hedge fund style of trading. But I guess the message is it is available for individual investors and it's
Oh, yeah.
not out of reach
Okay,
because
interesting.
good systems are not complicated. They're actually quite simple. And the technology to implement this is actually not that complicated once you know how to do it. You don't need to be a programming expert. You don't need to be, the world's best Python programmer or something like that. You don't need to understand all the APIs. You just need someone to guide you through it. But I have, many people, traders in my community who are now fully automated with a portfolio of systems across different strategies, different markets, different timeframes, and the computer runs the trading and they monitor the trading process.
Hmm. And how about bias of algorithms? In what ways do advanced algorithms contribute to creating these robust trading models that can adapt to changing market conditions? Because sometimes also there are some huge losses and kind of AI biases and other risks involved in the algorithm itself.
So I think this is where the backtesting of your strategies comes in. So backtesting means you take the rules, you put them into the software, you apply the rules to historical data, and you see, all of the historical trades the system would have taken, and you can look at the individual trades, you can look at the overall portfolio performance. And when we do that, what we're primarily doing is seeking to understand how the system performs, why it works, and where the risks are. So we're looking, when we do the backtest, we're looking for outliers, good and bad. We're looking for situations, market conditions where the system falls apart or doesn't work. We're looking for individual trades that took large losses, for example, and trying to find ways to avoid them in our system by adding rules or filters and so on. For example, I very early on I had a trend following system, and a trend following system is one that buys stocks that are going up, very clearly going up in a strong trend. You buy it, expecting the trend to continue. Eventually, the trend stops and it turns around and starts going down. At that point, you sell it. You make money in the middle. Now, I had a trend following system that was making money, but I kept having these trades that I was uncomfortable about. And I realized that I was uncomfortable because the stocks were quite volatile. The stocks were very gappy. They jumped around from day to day. And I looked at the charts of these losses that I was taking and realized that if I filter them out, maybe I could improve the performance of my system. So by backtesting these ideas to eliminate these individual risks, what I found was you can very much improve the performance of your systems. So I added some rules to eliminate stocks that are highly volatile. It improved the performance of the system, smoothed the returns, and increased the returns. Mm-hmm. So we're looking for those sorts of issues all of the time and gradually refining and improving our portfolio of strategies.
Mm-hmm. So let's discuss about future trends, because with emerging technologies like AI and machine learning, how do you see the role of systematic trading evolving? Because now we can actually ask our kind of agents, right? Stock trader agent to do stock trading for me, because he has they have all this information, right?
Yeah, look, I mean, theoretically, the idea sounds great, right? You have an AI, it's plugged into the markets, it knows all the information, it can make the right decision. But the challenge is, will it really make the right decision? And can the markets really be predicted? And what happens is, markets evolve gradually over time, but there's still human emotion in there. There's still economic trends. There's still fundamental shifts in the marketplace. There's still companies going out of business. There's still companies taking over. There's still real things happening in the world. And these real things typically play out over longer timeframes. And what I've seen, at least, is a lot of the technology is focused on really short-term trading. 1 minute charts, 5 minute charts, buying and selling really quickly, trying to, outsmart everyone in the blink of an eye. The challenge is, at the very short-term end of the market, there's a lot of noise. There's a lot of uncertainty. The trading costs are very high. And the profits that are made by data vendors and brokers are also very high. So a lot of these AI agents that are trading very short term and machine learning and everything are all focused on very short term algorithms. It's actually very hard to make money long term at the short term end like that. For the private trader, people like us, it's much easier to step back and go to a longer time frame, daily charts, weekly charts even, or weekly systems on daily charts, and trade longer term systems. When I say system, it really is an algo. It's the same as the short-term one. They're just different rules. But on a longer term time horizon, the impact of things like machine learning and high frequency trading and AI is, I think, slower to impact. So we still have a place. And I think for many years, we'll still have a place. I don't think that AI bots are taking over anytime soon. The marketing will tell you otherwise. There'll be many claims saying this is the best AI trading bot in the world. But really, there's no free money, right? If there is an edge, it'll get very quickly eroded because there's huge competition in that space, a lot of capital invested. But for us as individual traders, it's a matter of stepping back, trading a longer time frame above the noise so that we can still capture the big trends and the really significant moves in the market, and we can still benefit.
All right. So I would like to ask you a personal point of view. What are some of the major misconceptions around the stock trading and your systematic stock trading that you strongly disagree with?
Hmm. I think the first one is that it's easy. Many people will come to the market and say, "Oh, I'm a smart person. I can learn to trade. I know how to manage my risk. I'll be okay. I'll figure it out." And they just start buying and selling stocks, thinking that they can compete. What they don't realize is that it's a competition. It's a very high level competition. It's probably the toughest competition in the world. And so the mistake is coming into the markets naively, thinking it's easy. And the way you get around that is be humble. Realize that you're learning a craft, you're learning a vocation or a career, and that's going to take some time and energy to learn. The good thing is you don't have to go to university for 4 years and end up in hundreds of thousands of dollars of student loans in order to learn to trade. You can learn to trade in several months. Typically, I teach my students to go from beginner to mastery in about 6 months. And obviously, there's some time and resources invested in that, but it's nowhere near like learning a new career. It's not like learning to be a brain surgeon, but you do have to learn. So I think that's the biggest one is you've got to learn and you've got to be willing to be a beginner and acknowledge that you're a beginner and not bet the house thinking that you know it all when really you don't. So that's the big one.
So, in what manner the community helps your community helps develop the skills?
Yeah, so we have a couple of things in Enlightened Stock Trading. I have a whole a course, a program that teaches all of the aspects from launch through to building confidence, through to diversification, automation, and then really mastering the high level concepts. So having a curriculum that you work through and learn, I think is critical. Second one is having a community that you're surrounded by, like-minded communities, so that you can ask questions, share experience, and be supported and support others. Most traders, most people who are investing their money do it on their own. They're isolated. They don't have anyone sensible they can talk to about it. And that's a real problem because you don't know if you're doing the right things or the wrong things. You've got no one to call you out. You've got no one to sense check things with. And chances are you might have a buddy who trades or invests in stocks, but if your buddy is not professional, who knows if they're giving you good advice? Having a community of people who are on the same path, on the same journey, and doing it well is really, really powerful.
Oh, it's
I think
fantastic.
I think
Yeah.
there's one, just before we move on, I think there's one other misconception which I really think is important. And this comes up almost every time I tell someone I'm a trader. If I say, they say, "What do you do?" I say, "I trade stocks." "Oh, you're a day trader," is what they say.
Yeah.
It's like, hang on, I said I'm a trader, not a day trader. Now, the difference is lost on most people, but it's important. Most traders who are new to the markets assume that in order to be a trader and be successful, you have to trade very short term because you don't want to take up too much risk. So you look at very short-term charts, and because on a short-term chart, you've got no overnight risk, right? So therefore, it must be less risky because you're just trading in the day, and then you go flat at the end of the day. You don't hold overnight, and then you start trading the next day, and you're buying, selling, buying, selling. That must be less risky. It's absolutely not. That's a very common misconception. Overnight risk is not a big deal as long as your position size is okay. If you've got huge positions and you're massively leveraged, then yes, it's a problem. But if you trade sensibly, it's not. And in fact, if you look at the S&P 500 and you zoom out over the entire history of the S&P 500, and you looked at the proportion of the growth in the S&P 500 that happens during trading hours between the open and the close, and then you compare that to the proportion of the overall growth that happens outside of trading hours from the close to the open the next day, a lot of the positive drift in the market is outside of normal trading hours. So by taking overnight risk sensibly and trading slightly longer term, you actually have a much bigger natural edge because the market drifts up and it's the overnight edge that gives you a big chunk of that. Not all of it, but a big chunk of it. And if you're just trading a 5-minute chart and going to cash at the end of the day, A, you're super stressed. B, you've probably made a ton of
Mm,
mistakes. C, you probably don't have a profitable strategy because there's not many very profitable day traders. And
yeah,
D, you're missing out on the overnight edge.
exactly. Yeah, interesting. So, yeah, if we summarize it for someone who is listening to this interview and would like to walk away with one or two major takeaways, what would it be?
First one is if you're going to trade in stocks or crypto or futures or Forex or anything, you need a system. You need a set of rules that you know is profitable. And you need to have the confidence in those rules through backtesting. The way you backtesting builds confidence because you can see all the things that happen. You know the overnight, the gaps, you know the stocks that hit your stop loss, you know the losses, you know the wins, you know how many losses in a row, you know how many wins in a row because you've tested it. That builds confidence and it also shows you how much risk you can take on each trade and not get wiped out. So have a system, test it, manage your risk to stay in the game. The biggest mistake is being wiped out. If you want to win the game and build wealth long term, you have to stay in the game. So no matter what happens, no matter how crazy the market gets, no matter how bad the economy, you can't lose all your money. You've got to stay in the game. That means you've got to manage your risk well. Position size very small. Don't use much or any leverage so that you can't get wiped out. Then you can stay in the game long term, build your wealth, and ultimately achieve the goals that you set for yourself.
All right, fantastic, Adrian. That's were all my questions. Perhaps if I forgot to ask you something that you feel is important to our audience, please go ahead.
Oh, look, I think the last question really summarizes it. I'm big on having a system that you've tested and you've got confidence in. I think that eliminates the vast majority of mistakes that traders make, and it allows us to manage the risks that are inherent in investing so much more easily. So I think just going systematic and having a set of rules that you've tested for yourself is a huge leap forward above, what most people do. And so I think that's the main game. That's the thing that will give people the biggest advantage in the markets.
All right, fantastic. Thanks again, and I hope we will cooperate in the future, perhaps a more specific interview on other topic. It would be
Yeah,
great.
absolutely. I have a ton of resources that people could grab if they want
Yeah.
to learn something about systematic trading. If people go to enlightenedstocktrading.com/free, in there, you can get a system, so you can see what a system actually looks like. You can there's a couple of trading courses so that you can start this learning journey, and some books. And there's one particularly on risk management and diversification, which I think would be particularly useful for your viewers. So enlightenedstocktrading.com/free,
Hmm.
and I think there's a bunch of things there that will be useful.
Yeah, I think we will put it also on our show notes so that people can, who read this, can download it. All
Brilliant.
right, thanks again, and I wish you a great success. Hope we will see
Thanks very
each
much.
other.
Thanks for having me on the show.
Absolutely.